Well, as we know, the Aussie dollar dropped when yesterday's non-rate hike was unveiled. This morning it held at just above 66 US cents, but this afternoon it began slip-sliding away. And the nearer the destination, the more it's slip-sliding away. And now it's under 66 US cents and 60 euro cents. The share market came in for some pretty brisk selling as well, down 1.2% on the day, with banks especially under pressure, while retailers and miners were sold as well. The US market fell on the back of lower job openings in the US, and Asian markets fell even more because of some weak manufacturing surveys. And on commodity markets, iron ore, copper and gold fell while oil went up. On the matter of our motionless interest rates, here's a chart of the months of inaction between the RBA hitting the peak cash rate and starting to cut. The average is 9.8 months, but it was 6 months or less 3 times, which suggests the last hike was a mistake, hurriedly reversed. Incoming Governor Michelle Bullock will be hoping she doesn't get left with another mistake. And finally, here's a chart comparing this house price cycle with the other 2 big ones that started in 2008 and 2017. Now, this bounce over the past 5 months is about the same as the other 2 bounces, but when in 2019 prices started recovering from the 2017-18 bust, they were helped by the tailwind of 3 rate cuts. And when prices started rising again in January 2009 after the GFC, there had been 4 rate cuts, with 2 to come. This time, house prices started rising in February after 8 rate hikes and kept rising against the wind of 4 more. Absolutely unheard of. And that's finance.